I've been on a little bit of a kick with talking about owners' distributions and equity recently, and you might be wondering why. And the reason really is that the more you can understand this stuff, the more power is in your hands. And I want to help you guys understand the mechanics of this in order for you to harness this information and create better financial situations for yourself. When you have a better sense of what's happening and how it all works, you're going to be able to make better financial decisions. So we've talked about how oftentimes owners will think that their owners' distributions or draws show up in the P&L. And if you haven't already watched that video, I'll be sure to link it up here because it's definitely worth watching. But what I often see when I'm reviewing financials, and this will be for businesses that have been around for years and years and years, I often see that bookkeepers will still put taxes, all the taxes, into a profit and loss statement. And it's very important for you to know that some taxes can go into your profit and loss statement and are tax deductible, and some are equity transactions. So we need to understand which taxes go where, and you need to be able to read your financials and understand how much have I paid in estimated taxes and how much have I paid in payroll taxes and where do I find that kind of stuff. If you've ever been in that situation where you're trying to figure it out and you're trying to be like, I'm just looking for answers, then this video is for you. If you want to gain control over your financial situation and become more financially fluent, then this is the place for you. I'd love to have you as a subscriber if you aren't already subscribed. And if you are subscribed and you haven't clicked the notification bell, you can also do that because that will let you know when we post a new video. So I first want to talk about the different types of taxes that hit our businesses. So I'm sure you can think of some right off the top of your head, but some of the things that came to my mind are things like payroll taxes, what we pay for our employees' wages, those types of things. We also pay sales tax. You might even pay something called a use tax. When sales tax isn't collected, you might have to still pay a use tax on something. You could potentially have property taxes. That might be when you own land or a building, or maybe you own some type of equipment. You might need to pay some property taxes on those things. And the most common one, the things that most of us are usually thinking about when we think about taxes, is our income taxes. And income taxes can show up with federal. Obviously, that's what you think about with like paying the IRS. That's our federal income taxes. But you can also potentially have state income taxes for your business and local income taxes. So these are some things that you kind of need to be aware of and understand where do they show up on your financial statements. So when we are trying to figure out where they go on our financial statements, we need to think about whose responsibility is this at the end of the day? Is this the business's responsibility or is it the owner's responsibility to pay this tax? Okay, so there are situations where the owner should be paying the tax, and then there's situations where the business should be paying the tax. So I'm going to give you some really specific examples of when the business should be paying the taxes. So if the business has hired employees, the business pays employee payroll taxes, okay, or employer payroll taxes. If the business has bought equipment and receipts are showing sales tax, that is a tax deductible expense, that's a business expense, and you can put that on your P&L. If the business owns assets, let's say that the business owns a building and every year a property tax is assessed on that building, that is a business expense because the asset, the thing that is incurring the tax, is owned by the business, okay? Now, that would be different if the business owner had a building and was renting it to the business. That would be a different situation. We're not talking about that. We're talking about if the business owns the building, it will pay the property taxes, and that is a business expense. Another example of a state income tax would be something like I live in Washington State, and I just recently paid my business and occupation tax, which is a B&O tax. This type of tax is based on your top line revenue, and it's just like a rate associated to what type of services or products that you sell. And it is just like, it's just a tax you have to pay. It doesn't really matter if you made zero profit in the year. It doesn't matter. It's based on top line revenue, and it's just assessed on the business income. That is a state income tax that does not flow through to the business owner, and the business pays that tax. It's on the business's responsibility to pay that tax. Locally in Seattle, I know there are city taxes as well. Those are also So you've got state and then local taxes that get paid, and you report those to those state or local revenue into revenue departments. Depending on where you are, you might have some local taxes you need to consider. You probably have some state taxes to consider, but everybody will have federal taxes. Now, all the ones that I just mentioned, all of those are responsibilities of the business to pay. So when the business pays those show up on the profit and loss statement. There's usually a separate section. I like to put it down at the bottom. If you look at my chart of accounts, it's usually in the 8,000 section, which is taxes paid, state, local. You can see it down there. Now, some taxes are going to be the responsibility of the individual who owns the company. And this goes back to that concept of the flow-through entity. So a sole proprietorship, a LLC taxed as a sole proprietorship, a partnership, or an S corp, also an S corp taxed as a LLC. Yeah, S corp taxed as an LLC. All of those things are considered flow-through entities, and what that means is it means when the business earns profit, in the eyes of the IRS, the business owner has earned that money, not necessarily the business. So, for example, if Clara CFO makes $100,000 in profit, when I go to report my taxes, that $100,000, yes, I have other tax forms that sum everything up, but ultimately my personal income tax return will show that net profit on my personal tax return, okay? So I am responsible for paying those taxes, and the business itself does not pay the taxes separately to the IRS. It flows through to my personal income. Okay, now because of that, if you're any of those types of entities, your tax expense or your estimated tax payments or whatever you're paying when your taxes due, that's going to show up as an owner's distribution, and it's going to show up in your equity section of your balance sheet, okay? So I see people making estimated tax payments and they think, whew, this is really great because, I made that $50,000 estimated tax payment and that's gonna lower my profitability on my P&L because I see it there as an expense and it's gonna really help me out if I pay my taxes and it's gonna lower my tax bill. That's not how this works. So I wish that was the case. I wish the more we paid in taxes, it would reduce our taxable income, but that's just not how it works. Your taxable income is the profit, and it does not include those tax payments to the IRS. Okay, if you are a flow-through entity, which almost every single person on this channel, watching this channel, is going to be. If you're a C Corp, this is handled a little bit differently, a lot differently, but most of us are flow-through entities, okay? So it's very important that you understand this, and I want you to think about marking those transactions when you pay your taxes. I did a video talking about how I really like to see owner's equity set up, where we have a separate account for owner's distribution and then a separate account for owner's distribution / taxes. So when you make payments, I want those payments to go there in the equity section. Are you with me? Did I lose you? Are you guys doing okay? I want to make sure that this is really clear. Those federal taxes, those flow-through taxes, you might also potentially have some flow-through entity taxes on the state level as well. I believe it's California that does this, where there's, like, if you're an S Corp owner, you might also have taxes that are your personal liability, very similar to how we do it with the federal. I don't do taxes, so I'm not exactly sure all the states that might be subject to that. But, keep in mind, if it's flow through, if it's a personal, you as the person who owns the business has to pay those taxes to the IRS. That's going to be an equity transaction. Okay. All right. So what does this look like practically? What it's going to mean is that the owner's going to do a number of different things in order to get this information, like to pay their taxes. So I want to show you what you need to do with that. So let's say they write a check from the business. Let's say I owe $10,000 to the IRS for my estimated taxes. I write a check from my Clara CFO checkbook, mostly just because I didn't have time to move it over to my personal account. So I'm just going to write a straight check and I'm going to pop it in the mail. I'm going to put in the memo line who it's for. It's for me, for my 1040. I'm going to put, everything you're supposed to put in there. It's in the instructions when you make an estimated tax payment. I'll put an estimated tax payment little form in there too, so that when they get that check, they'll know who to apply the payment to. Now, you can do that, and when that check clears, you're going to code that, or you can go ahead and write it in ahead of time. You're going to code that to owner's distribution / taxes. So you're going to use the drop down, for the transaction and make sure that it goes to that tax account. You might also decide to electronically pay your tax bill, which is what I prefer to do. And if you do that, when that money goes out of the account, you again make sure you do use that drop down and code it to owner's distribution taxes. This doesn't matter if it's coming out of the business account directly to the taxing authority, or if it's coming out of the business account going to the owner. So the other situation is sometimes, I've done this before, where I write checks directly to myself. So let's say it's $10,000, write a check to Hannah Smolinski, put that into my personal bank account, and then pay the IRS out of my personal bank account. That's all treated the same way. That $10,000 check would be coded to owner's distribution taxes so that I can keep track of it to remember, like, how much was I supposed to pay the IRS? Now, the important thing is that when you pay yourself a distribution, you turn around and you pay it right to the IRS. So you have that, you don't pay yourself a distribution and then maybe pay the IRS a little bit less. Make sure that, you're doing your due diligence as the owner to make sure that you're not confusing your bookkeeper, basically, if you do it that way. So I hope this clears things up a little bit so that you can understand when you need to record your taxes as a equity transaction and where to do that in your newly formed account, owner's distribution / taxes, or if it goes onto your P&L, the business expenses, like really what are those business taxes, the payroll taxes, the property taxes, the income taxes that are not flow through income taxes. All of those can show up over there on the P&L and they are tax deductible. So that's pretty great. All right. Well, if you guys have any more questions about owner's distribution and equity, please let me know. I'd like to help clear this up and make sure that you guys have all the information you need so that you can make better decisions for your business. All right, talk to you soon. Bye, everybody.